Today we want to normalize the normal. I'm going to start with the ratios, or we call it the interpretation. We call it the interpretation of financial statements. So we are interpreting the financial statements. So the reason why we do this, we want to understand the performance of the company. We want to understand the future performance of the company, the position of the company. So in the exam, they would require you to do what? To calculate the ratios. So you must know the formulas. Once you know the formula, we expect you to get it right. So just know the formulas, then you're good to go. So guys, I've sent a question in the group. I've sent the test your understanding never, and some can also see the question there. Test your understanding number 1, never. I'm using the Kaplan textbook, page 321. So you can look at the document I have sent in the group, test your understanding number 1. So they are saying never is a company that manufactures and retails of its products. They are summarized financial statements. So we are given the profit or loss. If you look at the information, if you look at the question, we have the profit or loss for 2004 and the profit or loss for 2005. So we have two years here, 2004, 2005. So we have the profit or loss. The financial position is the same. We also have 2004. We also have 2005. So we want to calculate the ratios. So when we calculate the ratios are also known as the interpretation of FS. We are interpreting the books. We want to understand, like in terms of profitability, is your profitability improving or it's not, or it's deteriorating? We'll also look at the liquidity position. Do you have enough cash? Because cash is regarded as the lifeblood of the business. We say for the business to survive, it needs cash. You understand? We need cash for the business to survive. So we want to understand whether the company is liquid or is not liquid. If we say they are liquid, they have enough cash to even cover their current liabilities. You understand? We also need to look at the gearing ratios, whereby we look at the loans. Did the company took loan or not? Right. And on the loan or the debt, is it high or is not high? Right. So guys, I'll start with these are the ratios that we have. We have the profitability ratios. We have the profitability ratios. We have the profitability ratios. So we have the profitability ratios. Number 1, we have what is called the return on capital employed. Right. How do you calculate this one? Return on capital employed. We say PBIT over capital employed, or its net assets times 100. Number 2, asset turnover revenue over capital employed. I will explain these ratios. On the profitability, we have 4. Gross profit margin is gross profit over sales revenue times 100. Number 4, okay, this is gross profit margin. Net profit margin is net profit, is PBIT over sales revenue times 100. We have 4 formulas. Also need the the formula for capital employed. If it's not given, let me write capital employed.
So PBA, what does it mean? PBA.
PBIT stands for profit before interest and tax. Remember, when you make a profit, you pay the interest on loan. You also pay the tax authorities the tax. So this is the profit that you have generated. So it's also known as the operating profit. This is the operating profit. The profit that you get when you operate your business before you have paid all the interest or the tax. So that's the PBIT. Right, so guys, this is what I'm going to do. We are going to do this question to calculate all these ratios. But first of all, you need to know the formula for capital employed. Right, don't know about the formulas, I'll explain so that it will be easy for you to remember. If it's explained, it will be easy. Can you write this? The capital employed is equals to capital employed is equals to total assets. This one is right. Is equals to total assets less the current liabilities, or equity, or we say total equity plus the non-current liabilities. So these are the formulas. This or this. Right, you need these formulas: total assets less current liabilities. I'm going to teach you how to get the capital employed. You understand, guys? What does it mean when you say, what do you mean when you say capital employed? Remember what I said. I want you to understand that capital is not just the money that has been used to start the business, right? Any investment that you make is capital. You follow? So capital employed, we are looking at the money that was invested. So either in non-current assets, or we are looking at the equity section. These are the investments. You invest your money when you acquire assets. You understand? So that's why I said total assets. Or you invest your money when you buy shares. That's why we are looking at the equity. But now on total assets, these are the total investment. Maybe you include all the current assets, the non-current assets, such as the building, you buy buildings, right? So we are valuing the company. Total assets, but you less the current liabilities. Because the current liabilities, you expect to settle them within a short period of time, right? That's why we remove the current liabilities. But if you use the equity section, you add the non-current liabilities, and we don't even consider the current liabilities. Right. So let me give you this example first. So if I give you this example, on test your understanding number 1, you then calculate the capital employed. You follow, right? So let's do this, guys. Right. I hope you are all following. Trust the process. You understand this. This is my financial position. This is an example. So after this example, you are going to calculate the capital employed for me, for naval company, right? Using the financial position. You understand? Right. In the financial position, we record non-current assets, you agree with me? We also record the current assets, you agree? For example, let's say 10, current assets, let's say 5. So the total that you get will be known as the total assets. We have how much? 15, right? Then let me go to the equity section. Equity and liabilities. You start with your equity. You remember your equity. The share capital, share premium, or what? you add the total, the retained earnings. Let's say our equity is $8. On equity, we record equity and all the liabilities, right? The current liabilities and the non-what current liabilities, right? Let's say the current liabilities is 3. We want this account to balance now. 8 plus 3, that's what? 11, right? Plus 4, then we have 15. Right. So now I want to calculate the capital employed, the money that was invested. You understand? So when you tell people to calculate the capital employed, they will just say our capital employed is 15. You understand? Those balances that you are given, 15, 15 here. So most people, they think that we take this 15, 15. But we don't take the total. You can take it, but you have to adjust it. So just know that in the final exam, the total here will never be the capital employed. You have to adjust. So what are we saying? Capital employed, this is the money that was invested, which are our total assets. Do you remember the example that I always give you guys? Like you have $50, right, in your wallet, right? You have 50, but you are expecting to pay someone $20. So I'll ask you a question: that how much do you have? 50. We say in accounting, you say you have to say 30, because the 20 will be paid within a short period of time, right? So that's what we are saying. The current liabilities, these are the liabilities that you pay within 12 months. So we are saying, yes, we have 15 in total, but within 12 months, we will settle this amount, the current liabilities of how much? 3. So that's why we say less the current liabilities. So 15 less 3, what do you get? 12. So 12 is the capital employed. You understand? The total assets less the current liabilities. Or maybe you want to use the second formula. The second formula we said here, you will say equity plus what? We said equity plus which liabilities? Look at your formula. Equity plus what? Thank you. Are you seeing that we are not considering the current? So if we use this section, it will be 8 equity plus the non-current liabilities of 4. So you still get, that's the capital employed. You understand? Right. So guys, we want to do this question, never. So can you go to the financial position and calculate the capital employed for me? So I'm not saying use 2 formulas, just use one. Like the one that you prefer here. I think it's best if you just say total assets less the current liabilities. This is the total. The 732, this is the total, right? You then go to your current liabilities, you scroll down, you look for the current liabilities, you list all the current liabilities. So can you give me the capital employed for 2004 and for 2005? Right. So the first thing, calculate the capital employed. It will be used to calculate things, but it is used in the formula. So what is the capital employed? 2004, guys, for capital employed, 2004, capital employed for 2004. Remember, capital employed is not a ratio, right? Yes. For 2004, what about for 2005? 2004, there is the total. So I'm using total assets less current liabilities. That's the formula I'm using. So I'm seeing that the total given there, 732,110 for 2004, 1,038,445, right? This is the total assets, right? You less the current liabilities. You scroll down on the current liabilities. The current liabilities in total, if you look at your current liabilities, we have payables, overdraft, and tax. What is the total? It's 241,590, right? 241,590. What about for 2005? 430. 680. Right. You less what you get.
For the first one, 495.
So we are saying 732.
For 2004, I got 495.
You got what? 495.20, yes, correct. 495.20. What about 2005? $607,765. So guys, this is the capital employed, right? Now, so let's work the ratios. The first ratio. So I want to calculate the profitability ratios, guys. We want to measure the profitability of the company. So the first one was what? Was the return on capital employed. It's called ROS. So guys, this formula is easy to remember. Why? Why are you seeing this? This is what? Return on what? On capital employed. So what are the returns? When you operate your business, the aim is to make a profit. So when you say I now have the returns, you're talking about the profits that you have made. So it's profits over the capital employed. We now have the capital employed. You understand? So Ross, we are saying profit PBIT over the capital employed times 100. What is the profit before interest and tax? Let's look at your question and then go to the profit or loss. You move on to the profit or loss. The profit or loss. Are you seeing this? In the profit or loss, what is the PBIT? Remember, the PBIT is the same as the operating profit. You understand? Like before you have paid the interest, before you have paid the tax. So guys, we need before tax, we need before finance cost. Finance cost is the same as the interest on loan. Like when you get the finance, you incur the cost of interest. So we are taking this, the profit from operations, which is 235,450. 235,450. What about for 2005? 179,545. Over the capital employed, you now have the capital employed. The capital employed times 100 multiplied by 100. You get your answer here. That's the formula for us. Like we are looking at the investment that we have made, which is the denominator. Then what about the returns that you are getting? Are you getting the returns of 10% or 20% or 30%? So let's see. Do the number crunching exercise. You get what? 48% here. Here, I'm getting 30%. Like now, guys, I want you to understand this. In the exam, if you have to fill in, when they say round off to the nearest percent, it means they don't want the decimal places, right? When they say give us to one decimal place, make sure it's one decimal. If you round off when they say one decimal, the answer is wrong because they don't follow the instruction. You understand? So in this question, we haven't been told, so let's just round off to the whole number. Right? So that's the loss. The second formula was what? Assets turnover. Guys, do you know what this word means? Turnover. We are talking about the revenue. You understand? So this is revenue over what? Over the assets. Our assets are the capital employed, right? So you say revenue divided by capital employed. So on this one, you just divide. You just divide, you don't multiply by 100, right? So guys, if I give you this one, so this is what you do in the exam. You'll be given papers to do the calculations. If you are calculating ratios, put 2 columns. Understand? For 2004, second for the 2005. So guys, this one is easy. Just say revenue over capital employed. We have our capital employed, right? Number 3 and 4. Let's see this. The gross profit margin. Right. This formula is easy to remember. The GP margin, what are we saying here? Gross profit. Guys, is it your first time seeing the word margin? Margin, you link it with what?
Cost of
the margin
sales revenue.
with the sales, thank you. So remember, the margin is the profit, but it's expressed as a percentage of sales. You understand? So guys, whenever I see the word margin, I'll think of the sales. So here we are saying gross profit over what? Sales. You understand? So you need to remember the formula, that's all. The gross profit over sales times 100. Then I will do my calculation here. Then check your question. In the profit or loss, what is our GP? Let's kill 2 birds with 1 stone. You put the GP for 2004 here, GP for 2005 to save time. So GP for 2004, that's how much? 4 or 6 what? 400, right? What about for 2005? 340, 995. Right? What about the sales? You are giving the sales, guys. 1159, 850. Then the other one, 1391, 820. You multiply by 100. You multiply by 100. Are you seeing this? So now, in the exam, I explained, guys, that if they say we need 1 decimal place, 1 decimal place, they say 2 decimal place, 2 decimal place. If your answer is exact, like you got 25%, then just put 25%. But if you're getting 25.44, you understand? And they said give us 1 decimal to be 25.4. If you round off writing 25%, yet they want 1 decimal place, that will be the wrong answer. So guys, make sure that you follow the instructions. So most people, they don't follow, especially when they're too excited. In the exam, there's a question which the question requires you to calculate the GP margin. Then you are too excited because you remember the formula. Yes, it's not a bad thing, but make sure you read what you're required to do first, so that you do it right. Net profit margin. Net profit margin. Right, guys. The net profit margin, the formula. Are you seeing this is the same with GP, like the concept? Here on number 3, we said GP over the sales because there is margin. Here is net profit over what? The sales. You understand? But which profit are you taking? We don't take the profit for the year. When we are doing ratios, guys, we are measuring the performance of the company. So let's not consider the profit that was there after tax. Because after tax, you have included the finance cost, the interest alone, and the tax. Do you have control over tax? So the tax amount is reducing our profits. So you can't take the net profit after tax to measure the performance of the organization. Because the profit was already affected by the amount or by the tax which we don't have control over. So whenever we calculate the ratios, we use the profit before interest and tax, or it's known as the operating profit. So what's the operating profit here? I'm seeing 235, 450 for 2004. For 2005, 179, 545. You divide with the revenue. Revenue is the same here, 1159, 850, 1391, 820. You multiply by 100. You understand? So if you're able to remember the formula, then you're good to go. So this is the PBIT over sales times 100. That's the formula, right? Or should I say easy peasy? Guys, it's just a matter of remembering the formula. Remember, I always tell people that don't claim in the exam, right? Yes, but it's allowed to claim the formula. You understand? You can claim the formula. And not the question. Right. So we are done with the profitability ratios. We are done with the profitability ratios. Move on to the liquidity ratios. So guys, do not worry. Ratios. I know where the challenge was. It was in calculating the captain plate. Right, so liquidity now. Now guys, this is easy. Liquidity ratios, we are saying we want to see whether the company is liquid or is not liquid. Are you liquid? You understand? Do you have cash? If you're saying I don't have cash, it means you're not liquid. Someone might say, imagine someone who is selling goods. Maybe you're selling, maybe it's Dora, right? Dora is selling perfumes. So then the Dora is saying, I don't have cash, but if I sell these perfumes, I will get the cash. You understand? So this shows that Dora doesn't have cash. Yes, you might have the inventory, but the inventory is not cash. You need to convert that inventory to become what? Cash. You have to sell it. Maybe there are people that are owing you, and those people, they are called the trade receivables. They have your money, but the fact that you don't have that money, you are not liquid. You understand? We want to measure the liquidity. So we can do so by calculating the current ratio first. So the first ratio, current ratio. What's the formula for current ratio? I will just say current over current. Current over current. So this is the current assets divided by the current liabilities. So guys, you know current assets, right? The inventory, remember what I said, slow down please, Big Charlie, right? The inventory, the trade receivables, the what? The prepayments, the bank and the cash. Those are your current assets. So when we calculate the current ratio, we want to see if our current assets are enough to cover the current what? Liabilities. We are comparing the assets versus the current assets versus the current liabilities. Our current assets, are they enough to cover the current liabilities? Do you follow? Imagine the current assets are 50 and the current liabilities they are 50. What would be the answer? If they are equal, it will be 1. Are you following, guys? Right, I want you to follow. Right. 50 over 50, they are equal to 1. What about if it's 100 over 50? Are you seeing that the answer you get is 2? It's not greater than what? Than 1. So whenever they calculate the ratio, they compare with 1 to see if the ratio is greater than 1 or if it's less than 1. That's why when you get your answer, you just say 2:1. Do you follow? If it's greater than 1, it means the current assets are greater than the current liabilities. Do you understand? What about if I say 25, I need, let me say 10. 10 over 50, what do you get? Here, 0 point what? 0.2. Right? Here is 0, then that will be 2, right? S to what? You just say S to 1. And you are saying this, right? This shows that the answer we are getting is less than what? 1. If it's less than 1, it means the current liabilities are greater than current assets. You understand? So just master the formula. So it's current assets over current liabilities. Let's look at the question. So we go to the financial position. Financial position. What is the total current assets? 397.10 for 2004, right? What about for 2005? 528,855 divided by the current liabilities. The current liabilities 241, 590, 430, 680. Then you divide. You don't multiply by 100 because it's called the ratio. Ratio you divide. Two 41590. So I'm getting 1.6 S to 1. We divide there. It's 5885, right? I don't want to make a transposition error. It's 855 divided by 43680. That will be 1.2 S to 1. Are you seeing my answer? Now, this is the quick ratio, the current ratio I mean. Number 2, I want to calculate the formula for quick ratio, or it's called acid test. There is a slight difference between the current ratio and the quick one. When we are now looking at the quick ratio, we are looking at, remember what we were doing on number 1. We wanted to know if our current assets are enough to cover the current. Looking at this, are they enough to cover the liabilities? Yes, because they are greater than 1. You understand? So looking at this now, then on the quick ratio, then we just say, hang on a minute. To use the current, all the current assets is tricky. Because there is a current asset which is not easily converted into cash. You know your current assets, right? Which asset is not easily converted into cash? Slow down, please, Big Charlie. The first one, stock. Stock or the inventory is not easily converted into cash. You might not have the money to buy lunch, but you have stock, you have inventory that you can sell. But is it easy to just sell it? Yes, you can tell people that I'm selling this, but it doesn't mean they will buy. You understand? Some they even borrow on credit, and that person is a receivable. You have not yet received the cash. You understand? So in that case, you have converted the inventory to become the receivable. So it's not easy to convert it to cash. So on the quick ratio, we are saying, let's consider all the current assets that are easily converted into cash. And we say inventory is the only current asset that is not easily converted. So let's not include it in the formula. So we will say current assets less that inventory divided by the current liabilities. You understand? So on this one, what we did here, the difference is we are now removing the inventory. Are you seeing this? So you can even allow me to just copy and paste. You understand? Copy and paste, the liabilities is there. The liabilities, that's the denominator. What about the numerator now? You are now saying 390, 710, less your inventory. Your inventory on the question is 88, 760. Here, 528, 855. You less the inventory of 109, 400. So now, when you're calculating, guys, follow these steps. Don't do shortcuts. So the first thing that you do here, you deduct the inventory from 390. So you say 390, 710, less 88, 760. You get 301, 950. Here 528, 855. Less the 109, 400. You get 419, 455. You then divide. You divide. Then you equate to 1. You equate to 1. So 301, 950 divided by 241, 590. You get 1.2. Here, 436.80. You get 0.1. 0.97. So guys, this is the quick ratio, that's the formula. So just remember that quick, we are looking at the acid that are easily converted in cash. That's why it was given this name, acid test. Understand? Right, move on to number 3. Number 3. Right, well, number 3, guys, okay. On the liquidity, 3 ratios, we are left with 3, and they are easy. So should I say I will kill 3 birds with 1 stone? Right, let's do this. Right, 3, 4, 5. Now, number 3, we have the inventory days. We have the inventory days. We have the receivables days. We have the payables days. Right. The inventory days, when you buy a stock, how many days can you hold it in inventory? Like someone will buy stock, then they'll say, the stock that I purchased before, it will last maybe for maybe 30 days or 60 days. It depends with the customers, whether they like the product or they have the purchasing power. You might sell your stuff. How long does it take to sell everything? So we are looking at on the inventory days. How many days are you taking? Like, how many days will the inventory be in the warehouse before it is sold? You might market, you might do everything. Maybe someone will say, my stock doesn't last, people are buying that much. So we're looking at the inventory days. The formula is easy, right? So the days that we have per year, how many days do we have? 365. So this is inventory divided by, because it's inventory days. The receivables, these are the customers. They owe us money. How many days do they did they take to repay us? You understand? Like the receivables are the debtors. You can make a deal with them that pay within 30 days, pay within 60 days. If they pay after 30 days, it means the receivables days is 30 days, right? So the formula is the receivables divided by. The payables days, these are the suppliers. Payables divided by. Right? The inventory, when you hold the inventory, you incur cost. You understand? So we divide with the cost of sales multiplied by 365 days. So 365 days, our year is 365 days. So how many days? The receivables, what would have happened before for you to say, these are my receivables? We call them the receivables because we sold the goods to them on credit. So there were credit sales that were made. So you divide with the credit sales of the revenue, you multiply it with 365 days. The payables, you divide with what on the payables? Anyone to try on the payables? Yes. The payables we divide with the credit purchases. But when we are given statements now, you won't find the purchases separately. Where do we find the purchases? In the cost of what? Sales. So you divide with the cost of sales if you are not given the purchases, multiplied by 365 days. Guys, you multiply with the 365 days. So don't say, what if it's a leap year? Do you multiply by 366? No, guys. You don't multiply by 365 even if it's a leap year. The assumption is we use 365 days. Alright? This is on inventory for 2004, 8876. Inventory for 2005, 109,400. divide with the cost of sales. Obviously, cost of sales, that will be in the profit or loss. 753, 450, multiplied by 365 days. Then that will be 1 million sum. 825 by 365. So I'll ask you a question. 88760 is 88760 our inventory. Yes, divided by 753, 450 by 365. Let me just round. We are getting 43 days. 109,400 divided by. This is 38 days. So guys, how about this? Like, what do you understand by this? The inventory has decreased. Is it a good thing to the company? The inventory days have decreased from 43 to 38. Is it a good thing? It's a good thing, right?
Yeah. Because they're not taking less days to do it.
Yes, so this is a good thing, right? So we don't want the inventory days to increase. If it increases, it's not a good thing because some of the stock may be out of date, and if you're dealing with perishables, that will be a problem as well. Right, so receivables days are the receivables. So are you saying that if you remember the formula, that will be easy. The receivables, 455, divided by the credit sales. So now in the statement, you won't be given credit sales. You'll be given that revenue, that sales, just use that sales, right? That will be 159, 850, multiplied by 365. 1391, 820. Right. So, on this one now, I'm getting 65 days. All right? I'm getting 110 days. Is it a good thing? On the receivables. How about the receivables, guys? In 2004, they were paying us after 65 days. In 2005, they were paying us 110. Guys, you won't be able to.
They are leaving us with no liquid.
Yes, you won't be liquid, guys. So this is not a good thing. So if it's theory, I don't think you fail this kind of questions. It will be a theory. Then we'll say, which of the following is correct? On this one, this is not a good thing. You won't be liquid, right? They are not paying on time. We need cash to cover so many things that to cover expenses, right? So I think the company, this is never a company, right? The company should find ways to collect the debts on time. Like what? What do you do if you want to encourage the customers to pay you on time? What do? You can even give them discounts, right? If you pay within 30 days, you attract 5% discount. You understand? And also, the credit control department, like sometimes it might be because of the poor credit control department in the organization. Do you chase your customers? Or maybe you're not even following the payment for payments. Are you sending the invoices? You understand? Right? I don't want to say much on this one because you have to focus on the calculations in the exam. Payables days, payables over the credit purchases. What are the payables? Obviously, under the current liabilities. Current liabilities 2,419,590. This is 430. Guys, your exam is easy. You will be required to interpret the ratios. When you're doing FR, financial reporting, that's the advanced FA, that's when you'll be required to explain what this means. You understand? But in your exam, you're just calculating. The purchases are obviously in the cost of sales figure. So let's use the cost of sales figure. Or just take this one. This is the cost of sales. Remember the cost of sales. 753. 450.
Mr. Matthew,
Yes.
I have a question there on payables.
Yes, you can ask.
Why did you take the current liabilities figure instead of taking only payables?
On the what?
On and you are doing credit purchases then.
Yes. Payables.
Purchases. Yeah.
Oh, sorry. The amount that I took is what? Sorry. Thank you. So thank you. I did took the total. Are you saying that guys did the exam and then they make a mistake? So the payables. Thank you. The payables is 179. It's 179,590. Then for 2005 is 345. 48. You then multiply, guys, you get the days. What about the days, guys? If it increases, is it a good thing to the company or it's not? So here we have 87 days. 345, 480. 120 days. Is it a good thing now? The payables have increased from 87 to 120. Is it a good thing? What do you think, guys? You are not delaying payments.
We are not paying.
We are not paying our suppliers on time. Last year we were paying after 87. Now we are now paying after 120.
It's being caused by number 4.
It's caused by what?
Number 4.
Yes, yeah. So it's tit for tat. But guys, these are different. These are the customers, these are the suppliers. So you're saying that we don't have enough money to pay them, right? Mm-hmm. So, but is it good or bad? It's not good, right? Because if you delay payments, in the future they will refuse to give you goods on credit. So this will damage the relationship with the suppliers. You understand? Right. So those are the liquidity ratios. The last one, gearing, it's just one. Gearing. So gearing ratios, just one. Gearing. Now, on the gearing ratios now, this is what I like about the gearing ratios. In your exam, they will tell you that use this formula. Right, the gearing ratio, we are looking at the extent to which a company is depending on the borrowed funds, borrowed money. So we are comparing the debt versus equity. You understand? We want to see if your gearing ratio is high. If the gearing ratio is high, especially if it exceeds 50%, we'll be saying as a company, you are depending on borrowed funds. You understand? So on the gearing ratio, we say long-term debts over equity. Are you seeing this? Times 100%. Or we say long-term debts over equity plus long-term debts. So this one, you also put it as a denominator. Now, in short, we are saying, in the exam, they will say, use D over E. Just imagine. Or they will say, use D over E plus D. Just imagine. D over E, debt over equity. So we are comparing the money that you have borrowed versus the amount that you have invested, right? If the debt is too high, then you are depending on borrowed funds. In the exam, guys, if they say D over E, they are saying just use debt over equity. If they say D over E plus D, they are saying this D, you also need to include it as a denominator. Are you seeing this? So what is our long-term debt? The debt is the loan or the debenture. You understand? So we go on the non-current liabilities. We are looking at the long-term. Long-term, not current, please. You understand? So the long-term loan, that's 83. 100 divided by your total equity. What's your equity? What's your equity? The equity is what? 407, 420. This is for 2004, right? You multiply by 100. So 83 over 407, 420 times 100. I'm getting 20. I'm getting 20%. For 2005, so guys, let me just do it for 2004. I've used the debt over equity. What about for 2004? If you are using this formula, if I write debt here over this equity, if I'm using this formula, this debt you add it as a denominator like this. You understand? It will be by 100, so it will be this plus, you add first, so don't do shortcuts. Plus 83, 100, so this will be 490, 520 by 100, so 83, 100 divided by 490, 520, 83, 100 divided by 490, 520 times 100. You get 16.9, let me just say 17% if you use this formula. So, guys, I only did for 2004. You understand? So, if it's 2005, as long as you know the formula, you get it right. So, it's not a good thing for the gearing ratio to increase. You understand? If it increases, it means you are depending more on the borrowed money. You understand? Right? The last ratio on gearing is
why did the answer differ by 3%?
Because the formula is different. So that's what I'm saying. In the exam, they'll tell you to use, if they want you to use this formula, they'll say D over E in brackets. If they want you to use this, so they will give you the formula. Right? So the last formula on gearing, we have what is called the interest cover. So guys, we have the interest cover. When you make profits, this is the last formula, guys. When you make profits, you say your profit over your interest. Like the money that you pay every year, like you divide with the finance costs. Finance cost is the same as the interest on loan. You understand? I'll just do for 2004. What is the profit that you have made? The profit before interest and tax, the PBIT. You remember that profit? That this is the profit from operations. We made the profit of 235,450 divided by the finance cost. What is the amount that you pay every year? Remember, you took a loan, so every year you are paying how much? Every year we are paying 14,000, right? This is the interest that we are paying every year, 14,000. So we are paying 14,000 per year. So we want to see, look at our profit. How many times our profit can cover this money, right? So you say 14 into this amount, so 235,450 divided by 14,000. How many times? Let me just round off. I'm seeing 17 times. So our profit can cover the interest payment. How many times? 17 times. So if the times are many, the shareholders, they will be happy, because they will be saying our profit can cover this amount 17 times. So it means if it can cover this 17 times, we are able to pay the interest, we are able to pay the tax, and the balance will still be too high. Then they will be very sure that they will get dividends this year. They will be very sure that they will get profits, share of profits. You understand? Right, so those are the formulas, those are the ratios, guys. So we are done with the ratios. We are done with the ratios.